So we have taken a look at aggregate demand, and so now we're going to look at aggregate supply, which is a little bit more complicated in several ways. So go back to Module 2 and think about supply, one oil derrick producing something, the supply side of the equation. Well, aggregate supply is obviously going to be all of the production in the economy, all of the producers combined, because that's what the word aggregate means. So aggregate supply is the amount of goods and services, or real GDP, that firms will produce in an economy at different price levels. Remember, in theory, everything that is produced is sold, so it does make sense that just like aggregate demand is the amount of goods and services, real GDP, that's purchased, it makes sense that aggregate supply is the amount of goods and services that the firms will produce. But an easier way to think about it is just that it's the supply for everything by all firms. The reason that aggregate supply is more complicated is because it differentiates between, there's aggregate supply in the short run and there's aggregate supply in the long run. And there's actually not only two different curves, there are in fact three different curves that you're going to have to understand. So what is aggregate supply? So in the short run, you have to understand that wages and resource prices do not increase as inflation occurs. So I want you to think about this for a second. In the short run, if there's inflation in the economy, you do not immediately get a raise. There are a whole bunch of reasons for this. One is union contracts. You sign a contract, a union contract is usually between 1 and 3 years, and those wages don't change. Resource prices, sometimes they're called menu prices. McDonald's does not just immediately shift the price of its hamburgers if there's inflation, right? It takes a long time. So we call that sticky wages, sticky prices. And so this causes something that's interesting, which we will get to. Long run aggregate supply, we make the assumption that in the long run, wages and resource prices will increase as price level increases, flexible wages. So what this means is that, yes, while in the short run you might not get a raise, if there continues to be high inflation for year after year, you're going to go in at some point to your boss and say, I need a raise because my gas is more expensive, my groceries are more expensive, and I need more money. So we already established that in the short run, wages and resource prices will not increase as inflation occurs. And here's an example. Another way to think about it. If a firm currently makes 100 units that are sold for $1 each, and the only cost is $80 of labor, then they're making $20 of profit. Well, what happens in the short run if the price of their widgets or whatever it is that they're making doubles? Well, now they sell that same 100 units for $2 and they have a total revenue of $200. And how much profit? Well, the answer is $120 because because you didn't have to increase the price of labor. Even when you adjust for inflation, the CPI is 200 and the adjusted profit is 60. Okay? So with higher profits, the firm has the incentive to increase production. And we know that that's true even from way back in Module 2 with the with the normal supply curve. The profit incentive is what says that at higher prices firms are going to produce more. So let's take a look. It's not any different than many of the supply curves that you have seen so far, except this time it is aggregate supply. So that should feel very familiar. But like we said, there are three curves that you will eventually need to understand. But right now we're just going to start with the basics. So like we said, aggregate supply is the production of all firms in the economy, and you can see from the graph that as price level increases, the amount that firms in the United States are willing to produce increases as well. And we explained why on the previous slide. If they're getting more money for each unit that they're selling, they're going to be willing to produce more and thus create more output of real GDP. So now that you understand this basic curve, let's look at how the curve shifts, and then in a future video we're going to talk about the three different potential aggregate supply curves. So the first thing that could shift aggregate supply is a change in productivity. So think about technology. If a computer virus that exists that destroys half of the computers in the United States, well, guess what? Aggregate supply is going to shift to the left. We're not going to be able to produce as much. However, if we invent a teleportation machine and people can get around faster, aggregate supply is going to shift to the right. What about a change in resource price? Everybody needs resources in order to produce things. So let's say that there's an increase in the price of Canadian lumber. Let's say that we use that to produce houses in the United States. Well, aggregate supply is going to shift to the left. Okay. Let's say that there's a decrease in the price of Chinese steel, which we also use in a lot of our production. Aggregate supply is going to shift to the right. We're going to be able to produce more because we're getting our resources for cheaper. This also sometimes is called a supply shock. There's a negative supply shock. Let's say, for example, an oil embargo where the gas prices in the United States increase dramatically. But there can also be positive supply shocks. What could be a positive supply shock? You know, if some fundamental energy decreases massively in price, that would be a positive supply shock. A couple more shifts of aggregate supply. Changes in the action of the government, not government spending. So here we're talking about regulation and taxes, right? If there's a tax on producers, you're going to see if there's some type of change in taxes. So let's say that there's lower corporate taxes like is happening in 2017. You should see a massive increase in aggregate supply if those firms take that tax break and begin producing more with it, hiring more workers, investing in their businesses. Subsidies for domestic producers would also, if you lower subsidies for domestic farmers, that's actually lowering subsidies. So you're taking away subsidies for domestic farmers, they're not going to be able to produce as much. And then government regulations. If you have to have an EPA inspection to operate a farm, it's going to cause less production because less farms are going to go through the hassle to do that, or it's going to take them longer, etc. And lastly, there's a change in inflationary expectations. If some type of increase in aggregate demand leads people to expect higher inflation in the future, let's say that the Federal Reserve prints a lot of money and we expect inflation to increase, or the government gives a giant tax cut which increases aggregate demand at the same time that the Federal Reserve is printing lots of money, well then people are going to know that inflation is going to occur. This is going to increase labor and resource costs, and that inflationary expectation is going to cause a decrease in aggregate supply. People are going to expect that to happen, and they're going to decrease how much they want to produce. In the same breath, if people expect lower prices, then they will increase production and increase aggregate supply. So this is what an increase looks like, and this is what a decrease looks like. Remember, just like in normal supply and demand, you want to think about shifts in terms of right and left, not up and down, right? So a right shift is a increase, and a left shift is a decrease. Okay. In terms of the three different curves, we're going to talk about that in a future video.